qui a été important de voir, surtout dans cette édition, l'édition passée, c'est de voir qu'il y a des deals qui se clôturent pendant la FIS.
The annual Africa CEO Forum.
L'Africa CEO Forum.
Africa CEO Forum.
Le Davos africain.
Biggest event of its kind.
The IEA Electricity 2026 report confirms electricity demand is now growing faster than global GDP, marking a structural shift in how economies develop. The most critical transformation is the move from rigid, carbon-intensive system to digital, decentralized, efficiency-driven energy ecosystems. Electricity demand is growing structurally, and efficiency is the fastest, most cost-effective lever to strengthen grids while accelerating the transition. Grid constraints are limiting transition progress globally. Grid-enhancing technologies and digital tools could unlock between 1,200 and 1,600 gigawatts of system flexibility through better data and control. Digitalization and automation transformation infrastructure from a cost burden into a scalable enabler. Data improves visibility, unlocks flexibility, and allows grids to operate more efficiently while accelerating deployment in fast-growing markets. According to the IEA Electricity 2026 report, nearly 80% of global electricity demand growth through 2030 will come from emerging and developing economies, including Africa. Africa is not just participating in the energy transition, it has the opportunity to define it. By deploying decentralized, digital-first systems, the continent can industrialize, strengthen resilience, and avoid the constraints of legacy infrastructure. Our partnership reflects Schneider Electric's long-term commitment to Africa's competitiveness. Schneider Electric aims to assist African leaders turn energy ambitions into reliable, affordable, and sustainable outcomes.
Hello, I'm Ethiopius Tafara, Vice President for Africa at the International Finance Corporation. I'm pleased to share a few thoughts on the upcoming Africa CEO Forum.
Hello and welcome back. You're watching the Africa CEO Forum TV, and I'm your host, Terry Anchibet. We've had an incredible morning with the opening ceremony where His Excellency President Paul Kagame was part of that opening ceremony. Makta Diop, of course, a co-host of Africa CEO Forum 2026, was also here present with us. Amir Ben Yahmed, Jean Guy Africa as well. And that session was focusing on Africa at scale, with a focus on capital policy and, of course, the architecture for growth. Thereafter, the first opening panel discussion focused on scale or fail, why Africa must embrace shared ownership. And of course, shared ownership is the overarching theme in this year's Africa CEO Forum. Very, very excited and a very exciting time to be here in Kigali. I am your host, Terry Anchibet. So in just a moment, we will be moving over to our next session, which is a panel discussion happening in the main room. That's the Nairobi room. And the focus will be from cargo to kilowatt. Can Africans gas boom power Africa? And just a little bit about that session. Of course, Africa's upstream gas sector is really accelerating. We're seeing a lot going on across the continent in that space. Senegal's GTA reached export in 2025. We've also seen Congo shipping out its first LPG cargo in 2026, and the new LPG capacity across Nigeria and Mozambique is coming online quite imminently as well. But as geopolitical tensions and gas prices continue to rise, domestic gas-to-power frameworks and projects unfortunately are continuing to lag as well. And despite initiatives like the Mission 300 to build up domestic demand, export markets still remain the solar bet. So how can African actors align, when it comes to contracts, logistics, incentives, and of course financial structures quickly enough to capitalize and tap into their own power source? Now, the panel that is expected to engage in this deep dive conversation includes Tony Atta, who's the CEO and Managing Director, Renaissance Energy Company, Mike Sangster, Senior Vice President, Africa at Total Energies, Acha Leke, Senior Partner and Chairman, McKinsey Company Africa, William Asiko, Senior Vice President for Africa at the Rockefeller Foundation, Rostam Azizi, the Chairman of the Taifa Group of Companies, and will be moderated by Julian Samboko, who's the host of Business Redefined and the CEO chat at the Nation Media Group. And as we just prepare to head into that, I'd like to give you a glimpse of what to expect from the Africa CEO Forum TV today. We will have our next conversation at about 12, and the theme for that conversation is in the crossfire of Middle East tensions and tariff policies. How deeply will Africa's private sector be caught? I'm looking forward to an engaging conversation on that. And thereafter, we'll have another conversation on what does Africa's biggest telco have in store next to transform financial services. And of course, financial services, mobile money is a huge factor in Africa's growth in recent years, and that will be an insightful conversation just to deep dive into what that sector actually looks like. Well, for now, we'd like to now cross over to our next session, which I have just introduced. That's From Cargo to Kilowatt, Can Africa's Gas Boom Power Africa? That session will be moderated by Julian Samboko, who's the host, Business Redefined and CIO chat at the Nation Media Group. For now, enjoy, and we'll see you back at the Africa CEO Forum TV in just a moment.
Good morning, ladies and gentlemen. Good morning, ladies and gentlemen. Are we excited to be here? Once again, a warm and hearty welcome to all of us to Kigali. We are delighted to be part of the Africa CEO Forum, the 2026 edition, and the theme that we are riding on is on the imperative for scale. And that will be shaping our conversation this morning, which is titled From Cargo to Kilowatt. Can Africa's gas boom power the continent? And this conversation couldn't have been more timely, coming, of course, against the backdrop of the commodity price shock that we are currently experiencing following the tensions we have seen in the Middle East. And we want to have a conversation which will help us make sense of what we are seeing from a gas landscape in the continent. How do we address the question of bankability? How do we address the issues of export orientation? And can this finally help us revolutionize the economy that we have in this continent. It's a privilege to welcome you all to this session. We'll be running over the next 1 hour to be able to navigate the conversation items, as well as, if time allows, to take a few questions from you in the audience, and we'll certainly be welcoming that. To help me navigate this discussion, I have a distinguished panel, and let me begin by calling on stage the chair of the Africa Advisory Board Vision at Saudi Arabia, and that's the former Minister of Economy from Senegal, Mr. Amadou. Let's give him a round of applause as he joins us. Please take the second seat, sir. The second seat. There you go. Correct. Thank you very much for joining us on stage. Next on stage, I am calling Mr. Archer Leke, Senior Partner and Chairman at McKinsey. Please join us on stage. Karibu sana. You will be right next to the former minister. Please take your seat right here, right here. Thank you very much. We follow that order. And after that, I have the Senior Vice President for Africa from Rockefeller Foundation, Mr. William Asiko. Let's give him a round of applause as he comes. As Mr. Asiko takes his seat, we will be joined on stage by the Senior Vice President for Africa Total Energies, that is Mr. Mike Sangster. You're welcome on stage, sir. And finally, it is my distinct honor to welcome on stage Tony Attar, Chief Executive Officer and MD at Renaissance Energy Company. Let's give him a round of applause. Right. Gentlemen, welcome on set. I should mention at this point that we actually had a lady on this panel, but because of inevitable circumstances, she was not able to join us, just in case that question was going to come up. It's always good to preempt. We have a quick presentation to be made, which will take us about 5 minutes, so let me just walk on stage and make the presentation, which will set the scene for our conversation this morning.
Thank you, moderator. I'm not qualified to be on the panel, but they asked me to give an sort of expert presentation to just kick off and provide some context as we get into the session. So I'll just, typical consultants, we brought a few slides. I'll go very quickly, it's just a few slides just to, provide the right context as we start. First is understanding where we are from a gas perspective, right? So we are the fastest growing region from a gas demand perspective. We're growing 5 times faster than global average, right? It is small, let's be honest, it's small, the green line there, that's Africa, but it is the fastest growing region today. That's the first thing we should recognize. The second is what is driving that growth, and as you can imagine, it's power and industry, right? And we have sort of, how much demand comes from power. Power accounts for 60% of the demand. Between power and industry is going to account for 85%. So we need this gas, and we're going to talk about it today, to really power our industries and to power our electricity sector. That's where the demand is coming from. Third is, the good news is we have plenty of gas as a continent. We have plenty of gas. You can see the top 10 is about 10% of all global gas reserves sit in Africa. 7 countries, and you can see them listed here, account for about 90% of these reserves. And at current production rate, it will take probably 70 years to produce it, right? But we have plenty of gas, which is great. Now, what is the challenge? And I'm sure we're going to get into some of these issues in the panel. One is, if you look at that demand, where then does it get sent to? First is about 63% is domestic consumption. That number looks good, but the reality, it's only in 4 countries, extremely concentrated: Algeria, Nigeria, Egypt, and Libya. That's where you see some domestic consumption. 34% goes to exports, right? They're typically LNG exports out of a few countries. And the challenge, and we spoke about it again this morning, is the intra-Africa export. It's only 3%, right? And you see very few corridors from Nigeria to West Africa, Mozambique to South Africa. Very few corridors. But again, if we want to power our continent, we're going to have to figure out how to expand that. Now, what is the challenge with that? We also compared on different dimensions, sort of, a domestic regional consumption versus exports. On pricing attractiveness, it's much more attractive to export it. You make a lot more money, as you can see there, the prices in Europe versus what you'll make on the continent. The second is payment reliability. As I said, 60% of this goes to the power sector. We know that notoriously in many of our countries, there's been poor revenue collection from that sector. So the question we're going to talk about is how do you increase that and get more credible off-takers. The third is infrastructure. We talked about it, limited both in-country but also regional and cross-border infrastructure. And part of the challenge, and we'll talk about this, I'm sure, today, the next 2 days on infrastructure, right? Project bankability. How do you build these projects? The challenges from a funding perspective to project execution. So those are the challenges, and that's why it's a lot more attractive today to export it out to Europe or outside of Africa than to do it within the continent. Now, this is one of my favorite charts, which is very, very telling. We just looked at the pipelines, and we talked a bit today. Mactar spoke this morning about how we are geared towards sort of exporting outside of Africa. You look at the pipeline that exists; they're all geared toward exports. You have some that are planned, and some that are planned. But part of the challenge we have is, very few of our countries have meaningful domestic gas networks that's within the country. And then secondly, most of the cross-border infrastructure is actually moving the gas out of Africa and not within the continent. Finally, we also need to look at production costs. Our costs today, this is on average, right, about 25% higher than global average. Again, there are many reasons for that, right? But that is something we're going to have to look at. I'm sure we'll discuss on the panel. And so this, in my mind, is then, some of the issues we need to address. We talked about infrastructure, domestic and regional, how to build that infrastructure, credible off-takers, how to make sure that, people respect the contracts and you can count on that. Financing partners, we have some financiers here who've looked in this a lot. How do you combine from DFI, from MDBs, from the private sector, from governments? Harmonization, we talked about AFCFTA this morning. How do you harmonize some of these regulatory frameworks? And then the government support and commitment, that's absolutely critical. So I'll stop there and I'll hand it over to the panel. Thank you very much.
Thank you very much. Let's appreciate Acha for setting the scene for us. And as he said, trust a consultant to come with slides. In a previous life, I was also on that side of the world. Thank you very much for your insights. And we'll be relying on you also to help us take in some questions as and when they come. To my panelists, let me start with Mike from Total. Total has been in the continent for over a century. And you've just had the landscape that has been painted here. We've got plenty of gas, we've got bankability questions, and of course the export orientation. What are you seeing in terms of the lay of the land and how is it evolving over time?
Yeah, good morning. Thanks for the question and thanks for the opportunity to talk to you all this morning. We haven't quite been there for a century yet. I think it's 98 years. Yes. But we'll soon be celebrating our 1 century, which will be in Gabon, actually, which is still one of our affiliates. I mean, I think, Africa for Total Energies is super important. I mean, so we've been there for a long time. We're deeply rooted in Africa. Something like more than 10% of our global workforce is based in Africa. I mean, we employ directly some 12,000 people, and I don't know how many indirect jobs, that we're supporting beyond that. We're investing about $4 billion per year and have been doing so consistently and will continue to do so. I mean, it remains a huge part of our business. And we're also, obviously, I think, the largest player in the downstream business as well, with 4,500 service stations across the continent. So, I mean, it's a very important part of our business. We've got 4 legacy affiliates, Nigeria, Angola, Congo, Gabon. We produce about 1 million barrels per day operated production, barrels of oil equivalent, mix of oil and gas. They're still going well, lots of new investments. But again, there's lots of new opportunities in the continent. So, we're investing heavily now in the southern part and the eastern part of Africa. So, I mean, we have a large project in Uganda, Tanzania called Tilenga ECOP, which I'm sure many of you have heard of. And that's an onshore field in the kind of northwestern part of Uganda, and we're building a 1,400-kilometer pipeline to the coast in Tanga in Tanzania, and that should start up between now and the end of the year, which is a fantastic project. And obviously we've made some discoveries recently in Namibia, and we're excited about moving forward towards some really deep water developments in Namibia. And then of course we have Mozambique LNG, which is a project which we restarted earlier on this year. So I mean, there's lots of opportunities. we're also exploring. I think, it was mentioned on the slide about the potential resources in Africa. We still see lots of potential for exploration. We drilled a couple of wells in Congo this year. We made a discovery. We're drilling right now in Angola, and we're going to drill some wells in Namibia before the end of the year. And I think, one of the themes is about gas, and I think gas is becoming a much more important part of the business. We launched a project in Nigeria a year and a half ago called Ubeta, which is supplying gas to the domestic market into Nigeria LNG. We have one called IMA, which is right beside the Bonny LNG plant, which we should sanction in a few months' time as well. So I think, lots of opportunities there, but not just oil and gas. We have two poles in our business. One is the historical oil and gas business. The second one is what we call integrated power. And I think in Africa now we have over 1 gigawatt of renewable projects, either in operation or in construction, and lots of potential for more. I mean, I think it was mentioned this morning that I think 60% of the world's solar potential is in Africa, but I think only something like 2% of the global investment in renewables is in Africa. So the potential is clearly there. I think Atcha covered some of the challenges in his presentation already as to why there's not more investment in Africa. So I mean, we see it as has been a core part of our business, for many years, and there's many, many more new opportunities which are available. So we intend to continue investing, and I think we'll see more and more gas investments and more renewables investments as we move forward.
Thank you, Mike, for giving us perspective, especially in terms of the new opportunities you're unlocking in jurisdictions like Congo, and we'll be keeping tabs on that. Tony, first of all, help us understand Renaissance and what you do, and if you could help me also address the question of, we've got so much potential, plenty of gas, but infrastructure remains a key bottleneck. How can we begin to address that challenge?
Thank you very much, Julian. You've gone from 100 years to 1 year. I was going to say this is the first session that we're having with the Africa CEO Forum as Renaissance, but of course we're only 1 year old, unless we've been attending in our prenatal stages, but here we are. We are Renaissance, as I like to say, and you want me to speak to you about Renaissance. It is a new beginning, Julian, a rebirth, and for us, perhaps one of the greatest opportunities for not just Nigeria, but for Africa. And as we say, Renaissance Africa for a reason, because we believe that we're positioning to be perhaps the Renaissance, the African energy Renaissance is starting with us. It may not be very obvious, but we took over the Shell assets onshore last year as operator of the JV between NNPC, now Renaissance, Total, of course, still there for a few days, I would imagine, and AENR as operator of that joint venture, which is the largest joint venture today in Nigeria. We look at ourselves through the lens of Africa, and we set up a vision that is very audacious to say we want to be the energy leader in Africa. We put a stake in the ground. But most importantly, we want to enable energy security. Almost everything you heard about this morning is something we put as part of our vision to enable that. But most importantly, we want to support and be the catalyst for industrialization, starting from Nigeria and to the rest of Africa. But everything must be done sustainably. Now, you speak to infrastructure. The map that Atcha showed there was a very interesting one. Because if you look at that network, you can see quite quickly that there's no connectivity in Africa, which is very painful. But then he also confirmed to us that the resource is available. My portfolio today, 70% is gas. And when you look at energy transition, you look at saving the planet, you look at industrialization, most of it will be underpinned by gas. But the issue is not the resource. The issue is the resourcefulness that Africa has to change that paradigm of focusing on resource. You also heard about the paradigm shift from just extracting and exporting the resource. So we are pursuing what is a shared prosperity philosophy, but one that also integrates, first of all, starting within Nigeria, but then pivoting into the rest of Africa. That is the Renaissance vision. That is the Renaissance picture we have, for which we have set an ambition of 500,000 barrels of oil a day by 2030, and 1 BCF of gas for the domestic. which is about 9 times what it currently does today, because we believe that export gas cannot industrialize the country, cannot industrialize the continent. Domestic gas will be what industrializes nations. And that is why we've sort of started with 1 BCF for domestic and 2 BCF for export. Export to earn the money to make the industrialization happen. That is a start. It's been a year, but Renaissance is here and we're coming.
Thank you, Tony, and for your comfort, you know, those who profess Christianity will tell you it says 100 years is like 1 day. So even at 1 year, you're still doing fantastic well. Thank you very much for your thoughts there. And as you talk about the need for industrialization on the African continent, let me cross over to Bwana Siko. Many times, extractive sector contracts have been deemed to be quite punitive to the content, being export-oriented. Are you seeing a change in that, especially within the context of the present energy shock, where we are increasingly speaking about security of supply?
Thank you very much, Julians, and thank you to the previous speakers for setting this up for us. So we have been on the continent for 60 years, but as an organization, the Rockefeller Foundation is 113 years old. So I think we take the prize in terms of longevity. But let me just say this. I think we have to have very honest conversations as Africans about why we keep on talking about potential, and this potential has reliable electricity by 2030. Now, the reason I mention M300 is because M300 is taking a different approach to try to solve some of the challenges that we have seen and that Archer talked about as he made his presentation. So how do you use gas potential to connect 300 million people by 2030? And Julians, your question is about contracts specifically. So I'll just say this. First of all, to answer your questions, I don't really think contracts are the problem. I think those who are here in the private sector or those who have worked in this field or any other sector that requires contracting will know that the contracts are the final stage of the deal. The deal is made first and then you draft the contract. So contracts reflect what you have agreed. So they can, by their nature, not necessarily be the problem unless there is a challenge of bargaining power between the two parties, which is also a fact that we have to go. But coming back to Mission 300, so we as the 5 partners, like I said, the World Bank Group, including IFC, the African Development Bank, SE4All, the Global Energy Alliance, and the Rockefeller Foundation came together, bringing our different sets of expertise and capital to try to develop a program that was going to be different from programs that have been in the past. And how is it different? M300 starts with what is called an M300 compact. So a country sets out its roadmap, a roadmap of how it's going to get to universal energy access by 2030. And that roadmap includes, most critically, what are the policy reforms you're going to make? Because I believe this is one of the biggest challenges. Second, it includes what investments the public sector is prepared to do in that country. And then third, it includes what investments are required from the public sector, from philanthropy, from development banks, and others. This compact is not an agreement, but it is a document that commits the country to achieving its universal energy access goals. Now, during the opening session this morning, Makhtar Diop talked about taking documents out of the drawer and bringing them to life. That statement could not be truer for M300 compacts. These have to be roadmaps. You have to implement everything that is in that compact in order to achieve your goals. And one of the areas that, again, Archer talked about in his presentation is how do we convert our policy commitments into executable contracts? And I know that Mike and I were together at the Africa Forward Summit, and this is something he raised in front of 12 heads of state about the question about who is the off-taker. If you're asking Total to invest in a gas-fired electricity generation plant, who's going to be the off-taker in your country? In most situations, that off-taker is going to be a public utility. And many of our public utility face structural and financial problems. That has to be the beginning. Public utility reform is high up on the agenda of M300 compacts, but it has to be done. All the M300 compacts that we have, and I think we have about 34 now, all of them have got some commitment, apart from some countries that have already done a lot, and they're in the minority, to reform their public utilities. If you solve the question of who the off-taker is, we will no longer hear about the bankability problems of energy projects. That's just a fact. Bankability is a question of what is the entire supply chain from production, distribution, to offtake. And those numbers have to work together. So let me just say that we as Africans have to have that conversation, take the compacts out of the drawers, turn them into roadmaps for how you're going to get to your universal energy access goals, do the hard work to reform your public utilities, put in place policies that allow private sector to invest in not just generation, but transmission and distribution. There's no reason why private sector should not invest to provide electricity to one off-taker. If you are in extractives or you're in industry, the private sector can invest, and that can be the off-taker, bypassing the utility completely. So those are some of the things we need to look at, Julians, and I'll stop there. Thank you.
Allow me a quick follow-up to that point. Whereas the off-take is certainly necessary, the question that begs is it sufficient? Remember, in the presentation, we also saw the price differential between the Western markets, for instance, and what we see domestically. Wouldn't that be another hindrance?
Yes, no, listen, absolutely. I think that what Archer showed is that our supply chains today, those who are extracting, whether it's crude or gas, are looking at export markets. And that is true. Those should be part of the mix. There isn't a country in the world today that has resources of that nature that doesn't export. And I think we must take that into account. But the question we have today is, can we use our gas resources to power up our countries? That's the question. And that is certainly one of the solutions, is to have an offtake that includes export. And don't forget, there are different models, and Mike can talk about them, but the fact is that you can have a tariff system that allows for industry that requires large amounts of energy to subsidize domestic consumption. There are many models you can look at, but it does require you to have a functional utility or policies that allow the private sector to invest in those systems, whether it be production, generation, transmission, and distribution. In many cases, those three are left to public utilities or public generators, and these systems have to change if we're going to electrify our citizens at scale. Thank you, Julians.
Thank you for that. For those of us who come from East Africa, we know the debate we are currently having around open access regulations and how we are bypassing the utilities and what that means for the business landscape. Amadou, you've been quite active in government circles, in development finance. We've had the conversation here. One of the things that keeps coming back is a question of financing. And as Siko has indicated, bankability has a lot to factor in. But in terms of financing structures, what sort of mechanisms exist to be able to move this from cargo, as we say, to kilowatt? Yeah.
Thank you very much, Julian. It's a great pleasure to be here today. I'm part of Vision Invest, which is a Saudi investment holding company focused on infrastructure and now going into critical minerals as well. And infrastructure, we are investing in ports, airports, but also in power. We are known by having founded Aqua Power, which is the largest renewable energy and water desalination company in the world, listed on the stock market in Riyadh. And one of our other flagship is the Mid-Ocean Energy, which is a joint venture between Vision Invest, Saudi Aramco, and other investors, including EIG of the US. Last year, we invested in Arise, which was our first direct investment as Vision Invest, $300 million to support Arise grow in Africa, but also in the Middle East, in particular in Saudi Arabia. The question that you ask, Julian, is extremely important. If once you sort out the off-taker issue, you sort out the transport issues, you have the right contracts and all of that, the financing, in particular the long-term financing, is an issue on our continent. We're still relying too much on the hard currency financing. And then you have the mismatch because your revenue is most of the time in local currency. That's why the African Development Bank, I heard Sidita talking about this recently, sort of using guarantees to crowd in the African capital markets financing is extremely important. AFC produced a report that showed that Africa has $4.4 trillion of institutional and high network individuals' capital right here on the continent. But a lot of that money is going overseas. Our central banks are investing entirely their reserves outside the continent. Singapore, 30 years ago, 40, 50 years ago, decided to invest some of its huge financial reserves in Singapore itself to support the domestic economy. We invest in AAA rated overseas. Everybody tells us otherwise. Our central banks are not strong, and so on and so forth. And that's wrong. Those things have to change. I think our financial reserves, a good portion can be invested in long-term assets right here in the continent. And I think that takes policy, regulation, regulatory change, and political will to make those changes happen. You know, I heard the discussions that we had this morning. A lot is focused on using our gas domestically. I agree, but we need also to be very realistic. You know, these projects, to make them happen, you need tens of billions of dollars in some cases. And I do not see, you know, the IOCs or others being able to raise tens of billions of dollars with an off-taker that is a utility that is not strong, or where you don't have strong petrochemicals, steel manufacturing, and all of that, that has off-takers internationally. So I think we should not be dogmatic on these issues. We have to be very realistic. First of all, for our electricity, we need to privilege renewable energy because we cannot export renewable energy. We should maximize the use of wind, solar, in particular hydro, to the extent we cannot add more intermittent electricity on the grid, because that's our best strategy. So I rather maximize that, try to maximize industrialization, so transforming our raw materials locally using some of our that gas, but it cannot be 100%. But you need the export, in particular the LNG, to raise the money that you need. If you are like, you know, extracting gas 3,000 meters beneath, and you need $10 billion, you cannot just rely on a local utility to do that. What you can do, you can mix it. You can say part of the production will be used for local consumption, and then a big part used to enable the project to happen. Because if the project doesn't happen, it's on the ground and it's useless. And maybe after 40 years, 50, 60 years, it will no longer have the same value than what it has today. So we need to accelerate the extraction of our gas, be realistic, be pragmatic, negotiate with the IOCs to have some of that gas to power our industries locally, industries, not necessarily electricity. You can mix them, but let's privilege renewable energy, maximize our industry usage, and then maximize export, bring in the hard currency into the government coffers. Then the government can use that revenue to maybe even subsidize the local electricity and to invest in other areas where Africa is really behind.
Mr. Minister, you touched on the local funding, and I think that's a point we should come back to. But let me quickly just move on to Mike, because you talked about we need to be proactive in extracting the resource from Earth, because otherwise it is useless. Mike, you're doing a lot of work in Mozambique. Where does it stand today, and how are you handling this offtake discussion?
Yeah, thanks for the question. I think first I want to just say a word for Tony and just congratulate him on his first anniversary, because we've known each other for a long time. And, and honestly, since Renaissance has taken over the assets in Nigeria, I think they're doing a fantastic job to increase production. So, congratulations to a new African company. Yeah, I mean, I think, turning to Mozambique, I mean, I really agree with what Amadou has said. I mean, it's a huge project. It's a $20 billion investment. It can't be justified just on domestic demand. It's in a very remote location in Mozambique, right up at the north end of Mozambique, not far from the border with Tanzania. So I mean, yeah, it's an LNG project. I mean, it's 2 billion cubic feet of gas per day to be produced, 13 million tons of LNG, which will be sold, I mean, all over the world, but quite a lot of it going to Asian markets. And there's lots of potential beyond that. I mean, it's 65 teracubic feet of gas. I mean, I'm not sure the figures mean much to many people, but I mean, it's a huge gas resource. I mean, it's a world-class gas resource. But as part of the development, we also have a commitment to deliver gas to the domestic markets. I mean, I think up to 20% of our production should be delivered to the domestic market. So I think, the opportunities are there. But I say, because it's a remote location, and we need other entrepreneurs to invest in the region, in the Cabo Delgado region. What can we do with the gas? We can build a fertilizer plant. I mean, there could be power generation. I think there are lots of opportunities, but I think it requires a lot of investment. So I think this mix between export to help raise the funding and to guarantee the funding for the long term, and at the same time with domestic demand. And it's something that we do elsewhere as well. In Nigeria, we produce a lot of gas in Nigeria, and we supply local power plants, we supply fertilizer plants, we supply mini LNG plants as well, which is really useful for the country. But we also supply Nigeria LNG, and that was the kind of catalyst to move from flaring gas 20 years ago to monetizing gas through LNG. It's the same in Angola. We have an LNG plant in Angola, and again, just over 10% of the gas at the moment goes to a local power plant. So I think we shouldn't be looking at export or domestic. I think it needs to be a mix between export and domestic. We need to kind of have the best of both worlds. And I think we heard this morning in the plenary session. I mean, there's lots of potential of growth in Africa. I mean, the largest middle class in the world, in a few years' time. So I think the demand is there, but we need the investment, not just in the upstream side, if we're talking about gas, but also on the infrastructure side, whether it's on the pipelines, whether it's on the power plants, and whether it's on the transmission networks. So I think, there needs to be investments from the upstream companies, and we need the local entrepreneurs, we need international, utility companies, I think, to invest in Africa and to provide that infrastructure so we can monetize more of the products locally.
Thank you, Mike. Tony, you've had a $20 billion undertaking. You can imagine there. Here, Amadou is telling us we need strong participation from local capital pools to be able to take on this kind of high capex investment. But if you speak to the local capital holders, they will tell you, we fear the risk factor and the long-term nature of this kind of undertakings. When you look at the landscape as it is and the need for strong guarantees.
And that is why our focus on industrialization is very crucial. I said that with respect to the vision. That paradigm shift must happen for Africa to begin to take center stage and have that energy emancipation that we're looking for. Energy today is dignity. If you don't have energy, you don't have economics, you don't have dignity, and by implication, you have no power. And power, I say with tongue in cheek, and that pun is intended. If you look at Africa, 1.5 billion, over 600 million, almost 40%, does not have access to electricity, which is power. Look at that. We have in Africa 125 billion barrels of oil and over 620 trillion cubic feet of gas, which means nothing today if it is not applied for the cost of Africa. And for me, that is where the real issue is. And that is the narrative that we at Renaissance are actively working to change, starting from home. If you look at Nigeria, we have 200 million people. The total spinning reserve of electricity is under 20 gigawatts. And what is available for the population is about 5. So 5,000 megawatts for 200 million people. That's Nigeria. Of course, there are myriads of generators all over the place, but no economy can take off on the back of diesel generators. And in the same vein, no economy should expect to continue to take off on the balance sheet of others. So those $4 or $5 trillion that Amadou referenced, that is sitting elsewhere but belongs to Africans, and Africa has to come back. And that is how Africa would have to start to take center stage of financing itself. You can't keep expecting people to finance you and then you want to lead them or you want to stand up to them. You must be subservient if someone is financing you. As they say, who pays the piper dictates the tune. That is the story of Africa. But the story of Africa that we are working to reset is one of equality. It's one of equity. It's one that is consistent with some of those deals that you heard about. It's where Africa steps up to say, okay, yes, I want to export gas to you, but I also want some for my domestic development. And that is what we're looking for. I mean, think about it today. That 600 million is lack of access to electricity. The number is even worse when you talk about cleaner energy. It's almost 1 billion. And for me, that is even one of the most important aspects of our vision, where you look in Nigeria, 100,000 people, 100,000 people die every year from lack of access to clean energy. Just think about that poor woman who's trying to put food on the table, and she has to cook through the smoke using poor quality fuel. Walk in and out of that every day. Think about it. One child on the left, one child on the right, one on her back. They go in, day out. That is where your 100,000 people come from. The overall number for Africa is more than 400,000. That's not the narrative that you should feel proud of as an African. That's not the narrative you should be proud of as somebody in the industry that says we have 620 TCF of gas that can make it cleaner, that can provide life. Essentially, gas is life. And that is how Africa has to see gas. And if we as producers see it in that way, we now need to get that same logic in the minds of the leadership. Because integration is what has to happen in Africa. Yeah. The resources available in sketchy places, as you saw in Acha's pictures, but then if you look to the entire right-hand side, it's zero infrastructure. Yeah. Something has to shift in Africa for this connectivity to happen. And that is where the molecule becomes of value at home more than the revenue that is coming from outside. That's what Renaissance is about.
Thank you, Tony, and for humanizing it as such. Thank you very much for that. William Masiko, I'm very curious about your thoughts on this discussion of crowding in local capital into this undertaking.
Thank you, and I associate myself with the remarks made by Tony and my brother Amadou here about local capital and how to ensure that local capital is part of the mix in terms of investing in this production. Let me give you an example. Iceland is a country that is far from everywhere else. It's a European country, yet its biggest export is electricity. How do they do this? They have no interconnectors. They don't have undersea cables. 75 to 80% of the electricity that Iceland produces, and you know they have a lot of geothermal, that is actually sold to offshore companies that have built industrial production facilities in Iceland because they can offer cheap, affordable power that is clean. So we should look at domestic capital mobilization. We must look at that. But how about using our potential to produce electricity at scale, especially renewables, but also through gas, as long as it's affordable, to attract industry that will find it too expensive to produce in other places, especially in the EU now that is in the process of and I think has already launched its CBAM, the Carbon Border Market Adjustment mechanism that prices goods that are produced in the country or imported on the basis of how much carbon is used to produce that particular good. Now, can Africa take advantage of this? All right. If foreign investors are coming to set up their production facilities in Africa, that is a source of domestic revenue. That is coming, industry is coming to set up on the continent, in our countries. We need to look at alternative models. I agree completely with my brother Amadou. There's a lot of domestic capital. You know, I've heard so many different figures, but $4 trillion of African capital that is sitting outside Africa invested in assets of the continent of Africa. Why? We've got to solve this problem. That is potential domestic capital, all right? Raising domestic capital from our public resources as well. Our public resources rely on domestic capital from banks. They're crowding out private sector investment. So if you look at the bank balance sheets in many African countries, including ours, you and Julian, you find there's a lot of government paper in their books. This is money that could be being used by the private sector to do the kind of investments that we're talking about. These are things that are entirely within our control. And the reason that I am very passionate about them, Julians, is that we don't pay enough attention to the things that are in our control. Policies are in our control. Public utility reform is in our control. Domestic resource mobilization is in our control. We spend a lot of time as Africans going around the world talking about unfair system. Of course, the global financial architecture system is unfair. It was built at a time that Africa was not a significant player in the world economy, okay? And so it needs to reform. I don't take that away. But we should spend similar amounts of energy focused on things that we control. Public utility reform, public policy certainty, domestic resource mobilization in a way that makes sense. This $4 trillion in capital is made up of pension funds and other African company investments sitting outside of the continent. You know, I know that Amadou is probably with formerly with the African Development Bank, and the former president always used to take 10% of that. 10% of that is going to be significant in terms of delivering the kind of development we need. So absolutely, all the points raised are absolutely right, but we have to make them happen, Julians. We have to make them happen. African policymakers must start making these things happen and talk less about them and talk less about things they don't control and start focusing on things that they do. Thank you.
Thank you. Let's focus on the issues within our sphere of influence, and we can do something about it. Amadou, as an architect of economic reforms in Senegal, you are very big on the subject of local content. As we talk about the gas boom, how do we ensure that we are actually addressing that and ensuring that we address local needs in that matter?
Thank you, Julian. This is very important, not only for the hydrocarbon sector, in all sectors. In PPPs, we've done the reforms, where also the local content at 34%, let's say, on the capital of the SPV. on the gas sector, Senegal also has done big reforms in partnership with the oil companies, with everyone else. And the requirements was also that for certain type of works, the local private sector should be the one providing the service in partnership probably with other international entities, but the local sector should be very much involved. One policy area that was important was training, because this is a new sector for Senegal and for many other new players like Mauritania. So having a school and institute that trains the youth in this space was also something very important, and it was financed also by the oil majors, and that was something we are advocating also for other countries. So this is number one. Number two, local content in terms also of, having some of the gas, being used in Senegal. 10%, this is our first project in Senegal with BP for GTA, 10% to be used in the country, in majority for the electricity sector. But that is a start. For the second phase, though, of that same GTA project, a big chunk will be to transform the gas locally. So from day one, the signal that you're giving is that you are prepared to be realistic, to be pragmatic. So you have a small share staying in the country. But then for the second phase, the companies commit to basically utilize a lot of the gas, on the ground. So that will also help us increase local content. And number three, it's, control and monitoring. Having a local content law is very nice. You can copy paste from many other countries, but monitoring, transparency, making sure also not only the Ministry of Energy is basically monitoring, but also Parliament. So report to Parliament on a regular basis, on an annual basis at least, is something also I think that will add transparency. But one area where local content will not succeed if you don't fix it is also access to capital by our local entrepreneurs. That's a major issue on the continent, because you don't want to block the project by saying that 51% has to be owned, let's say, by local operators. And if they're not able to raise the money, then your project is stalled. You end up in a situation which is a lose-lose situation. So my advocacy is always to be pragmatic, to not be dogmatic, and I 100% agree with William. Let's focus on also things that we control. We control reforms. We control mobilizing our domestic resources, asking our central bank, our pension funds, putting regulation in place so that they can invest more locally. Those things, our policy makers, they control those things. But those things takes time to handle. In Senegal, we tried once to set up when I was Minister of Economy, to set up a fund that will take money from local savings to co-invest in infrastructure with PPP developers. We got stuck by the regulatory agency based in Côte d'Ivoire, which is a regional regulatory agency. They did not approve the project, basically. So we ended up not being able to mobilize local investors into PPP projects that are de-risk. Our idea was that you can put money to develop projects and then let the project be operated. You show the cash flows, that the risk is completely reduced, and then ask anybody to invest in that local fund so that we can take stake in those infrastructure projects that are already de-risked. But the political will, and then second, PPP reforms on private equity in our regional market. Until now, when I was minister, we started that discussion, but it's regional. It took us 3 years. I left. It's still there. We still don't have the framework so that we can attract private equity like it is done in Luxembourg, in New York, London, or in Mauritius. So these are things that we can control. So let's focus, as William said, on things that we can control, not talk about them, but just get them done.
A bit of regulatory lethargy there to be addressed.
Any questions from the floor before I invite my panelists for their closing remarks? I can see a hand here. Please introduce yourself and then shoot your question. Do you have roving microphones? I'll give you mine.
My name is Craig Powers, and I'm with S&P Global Energy, a division of S&P Global. Thank you to all the panelists for really some enlightening discussion and sharing your views. I have a question for Mr. Tony Atta, if I may. First of all, thank you for sharing your vision and indeed your strategy for enabling that vision. And I'd just like to ask you, is there a single most important factor that would help you achieve your vision of 1 BCF domestically?
Just before you go for it, do we have any other question? I want to bunch them up so we respond. There's a hand at the corner here, please. Right here. And there's another one on this side. Please go for it.
Thank you. I think, firstly, a wonderful panel. Thanks ever so much. I own a global headhunting firm, and we work across the extractive industries. My question comes from the regulatory angle. In the mining space and in Africa, the regulators are pushing the miners to not just take ore out of the ground and export it. They want to beneficiate. Could the same be applied to gas and oil, to pivot downstream by the regulators? Because I just get a sense that something has to change, and perhaps it needs to be political and or regulatory. Thank you.
Thank you for that question. Any other before we respond? Yes, there's a hand here. Let's take those three, then we'll respond.
Thank you, everyone. Abdullah Njai, professor of economics at NYU. So we mentioned policies at some point when we talked about pragmatism and realism. And for policies, I wonder, sometimes Africa comes to summits on, when we talk about gas, critical resources and minerals. What is there the scope for us to coordinate as a group to have a better position on these issues?
Thank you. Let me start with Tony. There was a direct question to you. Then Amadou, Mike, and William will see how to respond to the others.
No, thanks for the question. I mean, you spoke to the 1 BCF, but it's very important to underpin what we're doing in the export space. So we also set ambition for 2 BCF by 2030, which supplies Nigeria LNG. But as at January this year, we've been supplying 2.2 BCF export. And what we supply to domestic, under 200 million scarf. So you can see the huge delta. But your question is very, very valid. And I think the narrative from the Renaissance point of view is trying to break some of the old paradigms. Now, what tends to happen in the domestic space is the off-takers are saying, where is the gas? And the producers are saying, where is the contract? And that chain had gone on for too long. We're trying to fix ourselves as a nexus between the offtake and the production to the extent that we say, we will make it happen. And that is a risk that we're willing to position ourselves as Renaissance for, to ensure that there is confidence for both the offtaker and guarantee for the producer. That is how 1 BCF can happen. The need and the demand is there. The gas is there. But what was always missing was Renaissance, and we're here now.
Tony, you're a funny guy. There were 2 questions on the regulatory environment. I don't know who feels inspired to go first. Is it William? Is it Amadou? You'll take the first one? Go for it.
I mean, the first one on maybe having some sort of policy to ban exports of raw gas or raw oil, basically, like it is done maybe on the mining sector. I think, you know, the 2 sectors are very different. The mining is much smaller than the oil and gas sector in Africa. And having that kind of policy maybe will put us in a situation where we are not in a good competition position, probably. You know, just saying that 100% has to be transformed locally, I think that would be a problem. Maybe we can say gradually, let's say on your first project, 10, 20%, and then gradually over the next 15 years, you give time to everybody to do the needful so that that could happen. And remember also, the needful is not only the international investor. A lot of the needful is also local, is what William mentioned basically, things that we can control. I tend to say, let's do it gradually. Let's in parallel work on things that we control as well. And taking into account also that we are not the only producer of oil and gas. US is a huge producer of gas. You have Qatar, you have Russia, right? So we don't want to be in a position where we are not competitive as well. But I believe that you can do both. I think Egypt and Trinidad did the same, where you link, let's say, the price of domestic gas by the IOCs. Even if international prices are much higher, they were incentivized to sell to local operators at a lower price, but that was linked to the IRR of the project. So you have some structures that you can put in place so that that can happen. You know, at the end of the day, also, markets determine things. We have to be realistic about it. Maybe the fact that I was a banker also on Wall Street influenced a little bit my view. My view is always to not try to, you know, to sort of take the whip. You know, you need to incentivize, put conditions in place so that things can flow to where you want, and do them gradually as well, and give people time, you know, to adjust and make it happen. Yeah. William.
Hello and welcome back to the Africa CEO Forum TV 2026. I'm your host, Terry Anchibet, and we're ready for our next conversation of the day. And the theme we're looking at is in the crossfire of Middle East tensions and tariff politics. We're looking at how deeply Africa can or will be caught up in that particular tension. Of course, the Iran conflict and US import tariffs could profoundly impact the trajectory of the African economy, which had been projected to outpace the global economy at 4.6% growth in 2026 and in 2027 as well. But does that outlook still hold? I've got with me an expert panel to guide us through that conversation. Jeff Gable, Chief Economist at ABSA Group. Thanks so much for joining us this afternoon. Trudy Mahaya, partner at BCG, thank you for joining us, and John Shango, the Africa CEO at PwC. Thank you all so much for joining us. So I've got many questions, and we've got 20 minutes. So we'll try and do a quick fire as much as possible, and feel free to chip in. You know, should one of you say something that either one wants to chip in, please feel free to do that. But very quickly, let's just start by looking at some of the projections for Sub-Saharan Africa, projected at 4.6% this year, 4.6% next year again. But in light of the crisis in the Middle East and the global energy crisis as well as part of that equation, how far ahead can African economies sustain that projected growth? Let's start with you, Jeff.
So the risk to the 4.6, the direction is pretty clear, right? It's down, and that's not just for sub-Saharan Africa or Africa as a whole. That's for everywhere in the world. And this is going to be a period where we're kind of learning by doing, right? We're going to transition from a period where we're worried about prices. We hope we don't get to a period where we're worried about absolute supply. But if your broad question is, will Africa still be able to grow faster than the rest of the world? Well, we got quite a gap in that place, right? Maybe we're not doing as well as parts of Southeast Asia, but they're more exposed to the current crisis than we are. We can easily imagine a world in which in aggregate we continue to grow faster, that country-specific stories matter, and that we all look for the best way to navigate this very difficult period.
Trudy, I'll come to you. As the Iran and broader Middle East conflict sees the fuel prices rising and across the world, as Jeff has alluded to, what knock-on effects do you see businesses in Africa should expect in the coming months, particularly on the supply chain side?
Yeah, I mean, I actually want to touch both sides, right? Because I think we're already seeing the immediate challenges on African private sector. Differentiated, large companies having more resilience, smaller companies really coming under pressure, and also that intersection of size and sector, where if you're small and in agriculture, it really becomes difficult. But I think the way it plays out, from the supply side, we've seen the choke point, we're seeing the oil price trajectory is still pretty uncertain, but obviously much higher than we've seen in recent times or pre-conflict. And so that, of course, in itself is part of the story. It's really how it translates into different kinds of economy. So there's the clear logistics in terms of transport in an economy depending on fuel, and that coming to under strain and even shortages. We're also seeing the affordability challenge that's going to cascade. So if transport costs are elevated, inflation starts being elevated, fertilizer is starting to come into the story. Other chemicals are also becoming implicated, everything from sulfuric acid to really important industrial inputs. So then you see that businesses and households really coming under pressure from that. And then layer onto that potential demand side responses that governments might feel they have to impose, like curbing mobility, encouraging work from home, all the way to trying to restrict demand. And so then that really becomes an intersection between that supply and demand shock. And so I think we're going to see fairly difficult times going forward, because the second order effects are also layered by how governments and countries are able to persist. One thing I will add, though, is that we should never lose sight of the opportunities that could come out of this. I think the negative impact is so overwhelming, so immediate, that we don't want to discount that, but also think about where Africa is positioned to take advantage of its physical location in terms of rerouting of traffic, take advantage of being outside this current choke point, and also come to the fore and try to claim more of the value addition in this moment.
And of course we'll come back to that in a moment, just to see what opportunities are still there for Africa to sort of, I don't like to use the word resilience. I feel like it comes from such a, not the greatest place, and we use it too much as a continent. But let's move forward to protection. How can Africa protect itself in a time such as this, Dion?
Yeah. What I find fascinating about this time is that it actually forces Africa into action. That's the ultimate opportunity that I see here. Forces us into action in terms of diversifying where we source or import essential inputs from. Opportunity to actually bring to life once and for all something like the Continental Free Trade Agreement, FCTA, right? Implementation has been disappointingly slow. Barely 15-17% implementation if you look at what was initially envisaged through the agreement. Opportunity to actually relook at your historic geographic alignments in terms of your trading partners and seeing whether there's opportunities to bring in others in addition to the traditional partners such as the US, Europe, China, I think, will probably strengthen its position. We've already seen that in terms of being an influential player on the continent. So it is, yes, a crisis for the whole world, including Africa, but also a fantastic moment in time for Africa to actually sit up and think differently about how it manages the economy across the continent, how intra-Africa trade is pursued, and how collectively we can have a different conversation about doing things that can benefit most, if not all, countries on the continent.
We shouldn't waste the crisis, is what you say.
Absolutely.
And so the next question I'm coming to is also, one that has affected a number of countries, and that's in as far as U.S. policies and trade policies are concerned. And I'd like to ask this to all of you. Of course, with South Africa among those affected by Trump's import tariffs and so many other countries losing out from the benefits of AGOA as well. How far will this U.S. trade policies go towards disrupting African businesses? And there's a part of me that's like, why are we so dependent? How did we get there? But I guess, as you say, it's the time to take advantage of the crisis. Jeff, let's start with you.
So first, I think AGOA is helpful.
Of course.
Let's not make any mistake about that. But I don't think we should look to tie all trade between the continent and the U.S. with AGOA. The vast majority of the trade for the vast majority of countries has got nothing to do with AGOA. We're thinking about critical minerals, other resources, right? In that space, whether AGOA continues or not, neither here nor there for us. There are a few countries and a few industries that are very heavily impacted. I stay in South Africa. Right? Auto industry in South Africa, heavily impacted. But in that space, even if we had AGOA today, the Trump administration is looking globally to restrict auto imports into the U.S., so we would be impacted already. So AGOA is helpful. Most of the benefits to AGOA accrued to the most industrialized economies, which is a long-winded way of saying South Africa. Mm-hmm. Within South Africa, most of our trade wasn't under AGOA already. So it's a headwind, but doesn't fundamentally change how Africa reaches out to the world. It doesn't even fundamentally change how Africa reaches out to the U.S. So I want to sort of corral the question in a bit of a smaller box.
I love that. True.
Yeah, on that, I think that's spot on in terms of the impact of the US, but also, or rather of AGOA specifically, right? But also if you look at the US as a whole, the WTO kept releasing stats that kind of show that 80% of global trade was still outside that tariff net that had been imposed earlier last year. So there's still economic opportunity for Africa to tap into the emerging corridors that we're seeing in that. And I would want to zoom in on the EU and also on China. Because Europe, in many ways, strategically is in the same position that we're in, and we have a lot that we could work together on, history aside. So if we think about our manufacturing and our value addition, both of our continents have really suffered from deindustrialization for different reasons. And we can pool our capability and demand to actually capitalize on a moment. And we estimate about $1 trillion opportunity for EU-Africa trade. So that's the one element of it. If we look at the digital economy, similarly, US or rather EU and South Africa have a dependency that means we also need to think a little bit more about how we develop our own capabilities, but we'll need, as Africa alone, Europe alone, we need each other in that. So, I think the summit earlier tried to make those kinds of points in terms of that relationship. So I'm very bullish about it. Africa, China, we all know kind of the tensions that often arise where you're an export-oriented commodity player without any value addition. And so I think that corridor will persist. The challenge to work on is exactly that dynamic. So not to say that, if we're trading with China, we're giving up jobs or value addition. We need to reset that equation. And I think once we get those two corridors right, there's, we can worry about the US, but it becomes a much, much, much smaller worry. And of course, then we see the war in Iran. We're worried about GCC, FDI into the continent. But once again, I think we need to be steady there because those countries still have an interest in diversifying their own economic security by investing in the rest of the world, and Africa can benefit from that. So I see so much other potential, and then we can work on the US, at another time.
Dion, as you pick it up from Trudy, perhaps you could also just touch on the issue of balance of trade. In as much as the US markets or the EU markets are quite big for us, AGOA, as you say, may not be as it might not affect the African economy as much, but there's the issue of balance of trade as well.
Absolutely. I mean, you quoted at the start that the IMF had forecast 4.6% growth. Post the Iran conflict, that's come down slightly to 4.3%. But still, I mean, that's a credible number, and it's far outstrips the global economy performance, or at least what's been forecast. So the potential is there by the continent. And so we heard this morning about the underappreciated leverage we have by virtue of the critical minerals we have here, right? If we were to think more strategically about how we use that leverage, I think it would enable us to get much better balance in terms of who we trade with, on what terms, how to open up new markets, even existing influential partners like China. How do we get a better deal, given that everybody needs these critical minerals that are beneath Africa's soil? So definitely there are tools that we can work with, play with, in order to negotiate a far more commercial position for ourselves as a continent. Again, it requires collective will. It requires us to speak as one voice, as far as possible, and again, not lose this moment that we have, and capitalize on the crisis, turning it into an opportunity.
So, still staying with this moment, a crisis moment that we have, which will, of course, change the patterns of trade for the continent. I'm just curious, and I'm asking this to all of you, how you see those patterns changing in terms of who we're trading with. Of course, the US, the EU, China is now a staple. What other patterns do you see changing after this crisis, Jeff?
So we already saw before the onset of the crisis that the growth rate in trade was already stronger trade between Africa and the Middle East than the growth rate with Europe and the growth rate with the US. We expect to see the growth rate with China improve further. This offer from China for less restricted access into Chinese markets. Once we get sort of our standards in place, and once we can get the sort of the logistics changed in place, this is a fantastic opportunity. So it makes sense to me that over time our trading patterns are going to change. But it's also going to depend on the sorts of things we produce, right? So if we think that we are going to produce vehicles in Africa and export them to China, I think we're going to find that that's quite a steep hill. If we are going to focus around ground nuts and avocados, we got a fighting chance, right? So it's going to be thinking about the right sorts of things, but the rest of the world is open to trade. It's open to trade. The opportunity is there. The offers are there. It's for us to put in place the right mechanisms, the right logistics to take advantage of that.
Trudy?
Yeah. Let me focus back onto African integration, because I think the China GCC opportunities are definitely there and they will continue. But, my colleague here makes an important point about progress being painfully slow. And I think where we are, we just have to write a letter of gratitude to the policymakers to say, you've set the rules, right, and the frameworks. Yeah. But I also think as the private sector, we have to come in and drive some of the implementation, because once the rule books have been produced, the policymakers are also saying, but why aren't you trading? Where are the niggles? So let's elevate the fact that the agreement is wonderful, it's done, but it doesn't address some of the non-tariff barriers that are in place. So we can keep making that message. We can keep making the message around infrastructure. But I think we also need to be creative about what we do in terms of linkages amongst ourselves. So I mean, I look at the financial services industry. We have, banks that can connect the continent, and so they and connect the continent how? By connecting their own consumers. So start there. So I always feel like it shouldn't be a conversation of you on the other side of the table move faster, but it's actually we see what you've done. You've gotten to a point. Yeah. How do we then get even thinking about our own investments in terms of ESG investment. Why isn't ESG investment also driven towards investing in connectivity and trade enabling infrastructure? We often think about it as just our backyard. So I think those kinds of ideas can actually help to push and give momentum to integration.
Well, we've already seen, actually, Trudy, to your point, that looking at the digital evolution and adoption by the continent, we are digital first, right? Driven by having the youngest demographic of any continent. Increasingly, that's going to become AI first, even. And digital has this ability to be the connective tissue that actually brings countries together to do more together. So whilst the Continental Free Trade Agreement is a nice piece of paper, digital should actually push us in this direction of more integration, more trade. And again, we should be thinking Africa first in terms of how we think of trade. Not Africa only, but certainly more Africa first and then rest of the world, in order to, again, sorry to use this word, be more resilient to these crises and make sure that we try and insulate ourselves a lot better than what we have historically.
All right, so just add on the trade part, on the product element of it, I agree with Jeff on kind of really figuring out where we have comparative advantage. And let's also not forget trade and services, because I think there we also still have a fighting chance amongst ourselves, but also globally, where, AI also requires that human interface that I think we're able to bring to the fore, and our demographic headwinds enable us to do that effectively.
Okay. So final question, and I want to read it exactly as it is, because I heard Jeff saying earlier, why would I advise a CEO? Did you say that? So this question, finally, what would be your best piece of advice to African private sector CEOs in the global macroeconomic environment as we enter the second half of 2026? Jeff?
It's a very volatile period, right? So I think the next few months at least are going to be really high uncertainty periods. It's going to be risk mitigation, right? It's making sure that you're in the fight for when things clear up. Yeah. So that doesn't sound super sexy. That's not sort of signing the document that will set an investment path for the next 30 years. It's making sure that you're in a position to do that when the global clouds dissipate. Because what's happening today, right, it's very disappointing. We didn't start this, right? We're going to be impacted. It's very disappointing. But what's happening today is going to be with us for a period, and then it's going to be gone. And the story of Africa, at the country level, at the company level, at the continent level, the story of Africa is one of growth and opportunity. It's one of tremendous long-term investment case. And we need to make sure we don't lose sight of that. But right now, they're batting down the hatches, right?
Yeah. Truly. I mean, I think two things. I would say kind of work out the geopolitical muscle in your organization. So don't be the kind of organization where you're swayed by every headline and you become too embroiled and engrossed in that. At the same time, have proper sense-making capabilities to what does it actually mean for my bottom line, everything else aside. So I think kind of professionalizing that and getting really away from kind of the volatility and kind of understanding in a quantitative, analytical way is going to be important. I think all of us talk about geopolitics around the bar, and I think that's not going to be what a CEO needs to hear. So I think that's the one thing. On the other hand, I would say, and maybe this is also in collaboration with government, let's fight our internal choke points. Because we talk about the Strait of Hormuz and all of those other choke points, but the biggest are within the continent, not just amongst countries, but even within countries, just getting things from one point in a country to another. So I think just investing in those kinds of foundational capabilities in a business also kind of, it's a moment of entrepreneurship. We really need to attack these internal choke points so that we can have the scale that, this conference is about.
Yeah. So at the start of 2026, we released our latest annual Global CEO Survey. And this year's survey, CEOs, when answering the question, what keeps you most awake at night? And mind you, this was pre the Middle East conflict. They cited 4 things: geopolitical uncertainty, macroeconomic volatility across the globe, cyber risks, and the advent of artificial intelligence. And it's the type of response that is saying to us that CEOs are definitely feeling the pressure, to your point. They are feeling the pressure like never before. And this gives rise to the question, if they don't do something to their business models now, will their business still be in existence in its current form 10 years from now? And a surprising number of CEOs answered no, right? Their business models as they are today are not fit for purpose to survive and even thrive 10 years from now. And so I think my advice to a CEO would be use this crisis to take a fresh look at your business model and try and reinvent, reconfigure it as best as you can. Build for the long term, like Jeff said, even under this short-term uncertainty, however scary that may be, but you have to do it and just burrow it through the pain in order to still be in existence 10 years from now.
Fantastic. And on that point, we wrap up our conversation. I've been speaking with Jeff Gable, Chief Economist at Absa Group, Trudy Makaya, Partner at BCG, and Dion Shango, the African CEO at PwC. So we will take a short break. In another 15 minutes, we'll be here with another conversation with MTN on what the largest telco in the continent is doing over the next couple of years. We'll see you in a moment. Thank you.
The annual Africa CEO Forum.
L'Africa CEO Forum.
Africa CEO Forum.
Le Davos africain.
Biggest event of its kind on the continent.